Welcome to the deep dive. You sent us a fascinating document, International Standard on Auditing 805 Revised.
Yes, I say 805.
Now, stick with us here, folks, because if you're involved in finance, maybe financial reporting, auditing, or honestly, even if you're just curious about how financial accountability really works, unpacking this standard, well, it's going to give you a sharper edge.
Absolutely. Because at its core, ISA 805 Revised is all about the specific rules auditors follow when they're asked to look at just, let's say, a slice of a company's financial picture.
Just a slice.
Yeah, we're talking about auditing a single financial statement, like just the balance sheet, perhaps.
Okay.
Or even drilling down further, maybe looking at a specific part of one statement, like inventory or accounts receivable.
Okay, so to be crystal clear, this isn't the big full-blown audit of everything we usually hear about.
Yeah.
This is much more focused.
Precisely. Think of it like this. The usual ISAs, that's International Standards on Auditing, the main rule book.
Right, the overall frame.
They provide that broad framework. Then ISA 805 revised layers on the special considerations needed when the auditor's lens is really zoomed in.
On that specific statement or element?
Exactly. And our exploration today, it's based right on the standard itself. It lays out the scope, the objective, definitions, requirements.
And have examples, too, right, of the report.
It does, yes.
Yes.
Illustrative examples of the auditor's reports you might actually see in these focused kinds of audits.
Gotcha. So our mission for this deep dive, then, is really to pull out the crucial insights from ISA 805 Revised and understand how auditors think, what they're really looking for when they examine just one piece of that financial puzzle.
That's it. It's about understanding how the fundamental principles of auditing get adapted, how they're applied when the focus narrows down like this.
And for our listeners, why should they care?
Well, the key takeaway for them is if you ever see an audit report that only talks about one specific part of a company's finances, you'll know ISA 805 is the framework, the standard guiding that focused audit.
All right, gives you context for what you're reading. Okay, let's get into the nuts and bolts. What exactly is the scope here? And what's the main goal, the objective?
Okay, scope. It's clearly defined. ISA 805 Revised comes into play when an auditor is hired, engaged, to report on a single financial statement.
Like just the income statement, you said?
Could be,
Yeah.
yes. Or a specific element within the broader financial statements, like the total amount customers owe the company accounts receivable.
Okay.
Now, a really critical point here. This focus scope doesn't mean the other ISAs just, disappear.
Ah, right. You mentioned
All the standard requirements for doing an audit properly, they still apply. This standard just highlights the additional things auditors need to think about for these specific jobs.
So it's like the main ISAs are the foundation, and IS 805 gives you the special instructions when you're only building, say, one room of the house.
That's a perfect analogy. Yeah. And it's also important to note what it doesn't cover.
Oh.
It doesn't override ISA 600. That's the standard dealing with audits of group financial statements.
Okay, like a parent company with lots of subsidiaries.
Exactly. So if you're auditing a specific part of one subsidiary as part of that bigger group audit, you'd look at ISA 600 and ISA 805.
Got it. They work together in that case. So the objective then, what's the standard trying to achieve?
The main objective is simply to ensure that when an auditor applies the general ISAs to these more limited engagements, they properly address all the unique considerations that pop up.
Like what kind of considerations?
Well, everything from deciding if it's even appropriate to take the job in the first place.
Ah, the acceptance phase.
Right, through to how they plan and perform the actual audit work, and then crucially, how they form their opinion and what they say in their report.
Okay, so for our listener, the takeaway is that if you're looking at just one account, say ISA 805, make sure the auditor isn't just doing a quick look-see,
Right.
but is actually thinking about all the unique risks involved in that narrow view.
Exactly that. You're not seeing the full picture, so here are the extra things you absolutely must consider to do this right.
Makes total sense. Now, you've used this term, element of a financial statement. Can you unpack that a bit? What does that mean precisely?
Sure. The standard defines an element of a financial statement as, well, exactly that, a part or a component of a financial statement.
Give us some concrete examples.
Okay, think accounts receivable, the money customers owe, or inventory, the goods waiting to be sold. It could also be something like a schedule of plant assets, a detailed list of buildings, machinery.
The physical stuff.
Right. Those long-term assets.
But these are like the individual Lego bricks that make up the bigger financial statements.
Good way to put it, yes.
And when the standard mentions financial statements, generally in this context, are we talking the usual balance sheet, income statement, cash flow?
Yes, broadly. The definition clarifies financial statements here means a structured presentation of historical financial info. And importantly, it usually includes the related notes.
Ah, the notes. Crucial context.
Always. They provide the explanation behind the numbers.
Okay, so scope, definitions. Check. Now, what about before the audit even starts? What critical things does an auditor have to weigh up before agreeing to audit just one piece?
This is a really important gatekeeping step. The auditor has to carefully evaluate if accepting this kind of focused engagement is actually appropriate.
Okay, what makes it appropriate or not?
Well, one key factor is whether that same auditor is also auditing the company's complete set of financial statements.
Ah, okay, if they're doing both.
If they are, they need to think really carefully about how that specific element they're being asked to audit separately connects with, interacts with, the overall financial health shown in the full statements.
That makes intuitive sense. You wouldn't want to, give a clean bill of health to just the accounts receivable if the whole company's finances are clearly in trouble.
Exactly. You can't view it in complete isolation if you know the bigger picture.
And what if they're not auditing the full set? Just this one piece?
Even then, they still have to assess the financial reporting framework being used for that specific element.
The accounting rules, you mean?
Yeah.
Like GAAP or IFRS?
Or maybe even a special purpose framework like the cash basis.
Right.
The question is that framework acceptable? Is it the right basis given who's going to use this information and why?
Right. Does it fit for purpose for the intended audience and their decisions?
Precisely. It's not just about doing the audit right. It's about making sure the thing being audited is presented on a sound and relevant basis to begin with.
Okay. So let's say the auditor decides, yep, we can take this engagement on. What happens next? How does planning and actually doing the audit differ when you're just looking at one part versus the whole shebang?
That's a great question. The standard points out that auditing a single element often means you need to adapt how you apply some of the other broader ISAs.
Adapt how? Like scale them down?
Well, adapt the application. Think about materiality, for example.
Okay, materiality. The threshold for what size of error actually matters, right?
Exactly. What could influence a user's decision? When you're auditing just one element, say, cash balance, your materiality level might be set based on what's significant just for cash.
Which could be a much smaller number than materiality for the entire company's financial statements.
Potentially, yes. Much smaller. What looks like a tiny, insignificant rounding error at the whole company level could be a very big deal if it's in, say, the petty cash account.
Yeah. Okay, that makes a huge difference in focus. What else?
The auditor also needs to understand how that single element relates to the wider financial picture, even if they aren't auditing that wider picture themselves.
How so?
Well, for example, if you're auditing accounts receivable, how much customers owe, you still need to have some understanding of how the company actually makes sales, right? Which ties into revenue recognition, the income statement, and so on.
Got it. They don't exist in a vacuum. These pieces are interconnected.
Absolutely. Financial components rarely exist in total isolation. Now, this leads us to a really critical part, forming the opinion and issuing the report.
Right. This is where it gets, well, potentially complicated, doesn't it? Because the opinion isn't on the whole company's health.
Exactly. When the auditor issues their report on just a single financial statement or a specific element, that report has to be super clear about exactly what was audited.
No ambiguity.
None. And the opinion they give is specifically about that subject matter. And here's a really interesting, nuanced point.
Go on.
It's actually possible for an auditor to give an adverse opinion basically saying the full financials are materially misstated.
Okay, a bad opinion on the whole thing.
Or even issue a disclaimer, meaning they couldn't get enough evidence to form any opinion on the full set.
Right.
While at the same time, potentially giving a clean, unmodified opinion on a specific element within those financials.
Wow. Hold on. So the whole company's books could be a mess, but they might say the inventory count is perfectly fine.
If, and it's a big if, the issues causing the adverse opinion or disclaimer on the whole set don't significantly taint that specific element.
Ah, okay. So if the overall problem is, say, massive debt misrepresentation, that might not directly affect how they counted their physical stock.
Potentially, yes. It's nuanced. The standard also talks about how other modifications, qualified opinions, adverse opinions, disclaimers apply to these single element audits.
And things like emphasis of matter paragraphs.
Yes, or other matter paragraphs. Those might be needed to highlight specific issues users should know about, even if the opinion itself is clean.
Okay, but what if the big problem does affect the specific element?
Now that's the crucial safeguard. This is really important.
Okay.
If the auditor has issued an adverse opinion or a disclaimer on the complete set of financial statements,
Right.
and the reason for that bad opinion also significantly impacts the single element they are separately auditing,
Then what?
then the standard prohibits them from issuing a clean, unmodified opinion on that single element.
Uh-huh. So you can't say the arm is perfectly healthy if the whole body's sickness is clearly affecting the arm too.
That's a great analogy, yes.
Hmm.
It prevents contradictory reporting that could seriously mislead users. You can't have it both ways if the root problem connects them.
That makes absolute sense.
Correct.
Prevents confusion. Now, to make this less abstract, can you give us some more concrete examples? What are these specific elements that might get this ISA 805 treatment?
Sure. Appendix 1 in the standard is really helpful here. We've mentioned accounts receivable and inventory already.
Yep.
Another common one is the allowance for doubtful accounts, the estimate of receivables they won't collect.
Okay, bad debt provision.
Exactly. Or maybe the recorded value of identified intangible assets, things like patents, trademarks, goodwill perhaps.
Right, the non-physical assets.
You might also see audits of, a schedule of externally managed assets and income of a private pension plan,
Oh, very specific.
or a schedule of net tangible assets, or even things like a schedule of disbursements related to a lease property, or a schedule of profit participation or employee bonuses.
Wow, okay. So it really runs the gamut from major balance sheet items down to very specific schedules related to contracts or compensation.
It does. It shows the flexibility and the wide range of focused financial information that can be audited under this standard.
Those examples really help paint the picture. It's not just the big headliners. Now, the standard also includes example reports you mentioned. Appendix 2.
Yes, it gives 3 illustrations of what these auditors' reports might actually look like.
Okay, walk us through them briefly.
The first one is pretty straightforward. It's an auditor's report on just a balance sheet, a single financial statement,
Right.
and it's prepared using a general purpose framework like IFRS or US GAAP, the kind most people are familiar with. The illustration shows the standard report sections, what was audited, the balance sheet, management's responsibility, the auditor's responsibility, and then the opinion.
So familiar structure, just a narrower scope explicitly stated.
Exactly, clear focus.
What's the second example?
The second one is quite different. It's a report on a statement of cash receipts and disbursements.
Okay, not a full accrual-based statement.
Right. It's considered a specific element here. And critically, it's prepared using a special purpose framework, the cash basis of accounting.
Which tracks actual cash in and out, not earned revenue or incurred expenses.
Correct. And you can see in the illustrative report how the language is adapted. It talks about the cash basis. It focuses just on receipts and disbursements. The wording changes to fit the specific context.
Tailored to the basis of accounting and the specific information. Got it. And the third one?
The final illustration is a report on an accounts receivable schedule. Again, a specific element.
We keep coming back to accounts receivable.
It's a common one. But here, the twist is that the schedule is prepared according to a special purpose framework that's compliance-based.
Compliance-based. What does that mean in this context?
It means the audit isn't just about whether the numbers are right, but also whether the accounts receivable schedule complies with certain specific rules, criteria, or maybe regulations defined in an agreement.
So it's checking against a set of external rules, not just general accounting principles.
Precisely. So the auditor's report here would address that compliance aspect as well. It really shows how specific these engagements and the resulting reports can be.
Those examples are incredibly helpful. They really bridge the gap from the standards text to, actual audit practice. Okay, as we start to wrap up this deep dive then, what's the single most crucial takeaway for our listeners from ISA 805 Revised?
I'd say the core message is this. ISA 805 Revised provides that necessary structured framework for auditors when the job is focused, when it's less than a full set of financial statements.
Right.
And it really underscores that even though the focus is narrower, The fundamental principles, the rigor of a full audit still apply. They just need to be carefully adapted.
Yeah, it's not audit light, it's audit focused. It's about applying the same level of professional skepticism and diligence to a more defined area.
Exactly. No shortcuts allowed.
And understanding this standard, even if you're not an auditor, it gives you valuable insight, doesn't it, into how specific pieces of financial information can be put under the microscope.
It really does. It highlights that even, seemingly minor components can be subject to detailed, independent scrutiny and assurance. Nothing's too small to potentially matter.
So that leads to maybe a final thought for our listeners. Considering that even these individual elements, these schedules, these single accounts, can be subject to a detailed audit, what does that really tell us about the importance of accuracy and transparency at absolutely every level of financial reporting?
That's a great question to ponder.
It really makes you think, doesn't it? How every single number, every schedule contributes to the overall picture and could potentially face this kind of focus examination.
It certainly does. It reinforces that idea that financial integrity isn't just about the big, splashy headline numbers. It's built on the reliability and accuracy of all the underlying details, too.
Well, this has been a genuinely insightful deep dive into ISA 805 Revised. Thank you so much for breaking it down so clearly for us.
My pleasure. Glad to discuss it.
And thank you, our listener, for joining us on the deep dive. We'll catch you next time with another fascinating topic to explore.